All right, everybody, welcome back to another episode of the Evernest Real Estate Investor Podcast. I am one of your hosts, Spencer Sutton, and I've got back with me Gray Hall. Gray, welcome back to the show.
We have upgraded and replaced our third co-host with an exciting guest today. So excited to catch up, hear about his experience, and be able to learn from him.
Yeah, Matthew, we're just kind of tired of Matthew. We bumped him from the show for a few episodes. But no, seriously, we do have a great guest with us. We have Jonathan Mednick joining us. He's located in Birmingham, Alabama. He is the co-owner of REI Trader, along with his partner, Jeff Shadrick. And Jonathan, welcome to the show.
Thanks, guys. It's always a pleasure to be back with you.
Yeah, Jonathan, you've been with us on a couple of our other podcasts, the Birmingham Real Estate Investor. This one is probably a bit of a broader audience, people from around the country. And so I'm just going to give a little intro. I mean, last time we spoke, Jonathan, just to kind of give a background real quickly, Jonathan is a very experienced investor. He has done a little bit of everything, which we're going to get into today. He owns he and his partner own a lot of rentals. They've sold a lot of turnkey properties to people, and now they're into multifamily short-term rentals. And so, Jonathan, we're excited to get to talk to you today. And so let's just kick this off. I think what a lot of investors like to know when we bring an experienced investor onto the show is, like, how did you get started? How did you, first of all, I know you're not from Birmingham. So how did you end up in Birmingham? And then how did you decide, like, what was the process going full-time into real estate for you?
Last month, I celebrated 20 years of doing this. And when I meet people and they ask me what I do for a living, I say I'm happily unemployed. It's not a job for me. It's a lifestyle choice. Obviously, it's a business and you need to treat it as such. But I started back in April of 2002. Prior to that, I was in the tech sector, worked for Arthur Andersen, worked for IBM. System integrators. I provided business intelligence and strategy to big corporations like Disney and some other large corporations who wanted to web enable their services and bring them online. Of course, the internet was in its infancy back then, but in 2001, you all remember the dot-bomb explosion. The market crashed and we all lost our jobs, and I lost my high-figure, six-figure job, and decided I needed to shift gears. And so I was in Fort Lauderdale for about 15 years. Prior to that, I'm originally from the New York City area. I moved down to Fort Lauderdale, just needed a change, thought it would be a great lifestyle to move down there. And that's how I got down to South Florida. And in 2002, after I lost my job in the tech sector, I was looking around for something else to do. I think I had it working for the man. And I had a Carlton Sheets course that I purchased in 1996. One night, I was up late, saw the infomercial like at 2 a.m., ordered the course, like $149. And it literally sat unwrapped in its original packaging from 1996 for 6 years. And I pulled it out and I thought, this might be interesting. And let me look at this. Maybe this is something I can do. And so started delving into the whole no money down approach. Back then you can do it, a little different market now. And lo and behold, about 2 months after that, I closed my first deal. I wholesaled my first deal in Hallandale Beach, Florida. And I made $18,000 on an assignment fee. And I'm at closing and I'm walking away with a check and I'm thinking, this is not real. I'm going to go to jail. I'm looking behind me and I'm thinking the cops are right there. Take me away.
That's right.
I'm going to prison.
You just did something illegal, right?
Yeah. Yes. However, I walked away and I have this check in my hand. It's the biggest check I've ever gotten at any given time. And I'm thinking, well, this can't be real. And I wasn't excited because I thought maybe I was a one-trick pony and this is like one and done. I'm never going to do this deal again. And in about 6 weeks later, I closed my next deal. I did a short sale double closing, which of course is an entirely different topic. And I made 10 grand. I said, okay, I think I can do this for a career. 20 years later, I've done north of 2,000 projects. And getting here, going from Fort Lauderdale to Birmingham in 2011, when the market crashed in 2008, and all the experienced investors, we all took a dive. I was hanging on by a thread, rebuilding my, digging out of debt, rebuilding my network, trying to get back on track. Had a couple of partners. They went back to the regular jobs. I decided to stay in real estate, and came across a company in LA who was looking to buy properties, turnkey properties in Jacksonville, Florida. So I started working with them. I thought I was moving there. I sold them, 17, 18 houses. And then I saw an article in Wall Street Journal about the best markets in the country for buying and holding properties. And Birmingham was in that top 10 list. I think they were number 4. And so started to do some research, and I asked these guys in LA, hey, would you mind if I moved to Birmingham? I didn't have anything else going on in Fort Lauderdale. I was happy for the change. I didn't know anyone in Birmingham. Wasn't moving here for the lifestyle I didn't know anyone. And so September 1st, 2011, I arrived in Birmingham and haven't looked back at all. And, don't miss Florida at all. I have lots of friends down there, but don't miss the hurricanes. But I've been in Birmingham now 10 plus years, and this is how we got here.
I love it. And I'd love to kind of dig in. So you were started in 2002, and then were you investing through the crash? Did you start to buy properties? You kind of mentioned digging out of debt. I mean, I think a lot of investors that we talk to, it's in the back of their mind, hey, what happens if the market does change? We're in an interesting kind of market right now. What advice do you have to people? Like, what does your kind of portfolio look like? And kind of talk about maybe the 07 to 11 period.
Yeah, I will tell you this. When I started, I wish I started when I was younger, much younger. I started at 37. I wish I started when I was in my 20s. And in South Florida, really, because at that time, values were just creeping up, and they just shot up tremendously. And we were doing really well. And the strategies we employed was really more fixing and flipping because of insurance being so high and taxes being high. At that time, in the early 2000s, you couldn't really hold properties for cash flow, not in that market. Mm-hmm. So we primarily, with myself and my 2 business partners, we fix and flip everything. And we wholesale. On average, we were making about $19,000 on a assignment fee. And we flip like 3 properties a month, and the rest we would fix and flip. And we're talking probably sub 350, from 200 to 350,000. So that sweet spot. In 2006, I guess someone who is as close to being a mentor as I've ever had, in that summer, he said to me, hey, listen, the market's starting to shift. You need to dial it back. I see, warning signs, and you need to shift gears. And I think hubris got the best of me. And I just responded, what are you talking about? This is the greatest market ever. It's never going to go south.
It's going to last forever.
It's going to be like this forever. Right. And when 2008 came along, I think the first time I realized that when I went to a closing, and we were doing a double closing, a $30,000 profit, and my buyer didn't show up. He just didn't show up. And I think that was like the first warning sign. And anyway, we had a bunch of properties. We're doing some pre-construction flips in central Florida, and also the western part of Florida, like in Cape Coral area. And by 2008, or actually 2007 is when it really started. Everything started going south. And I'd say by the end of 2008, I was about $1.5 million in debt. And it hurt. But, since that time, I've been able to dig myself out, paid off all my debt, settle it, never filed bankruptcy, kind of moved on. 2013, I've become debt free. And of course, any seasoned investor who said they didn't take any lumps and they were around in 2008 is, probably being misleading, because we all have these same stories. But the difference here in 2008 is that I had tunnel vision, and I had one exit strategy, and that was fixing and flipping. I was in a very, very highly speculative market, and I just thought it was going to be like this forever. And of course, now in hindsight, in 20 years of doing this, I've gotten very conservative in my investing approach. And so our business is set up today in a very different way to benefit from a bull market, which is what we're in now, as well as a bear market.
What are the ways that you kind of structure? You talked about exit strategies. What are some other things that you can structure your company and portfolio to kind of benefit from, protect the downside, but also be able to capitalize on the upside?
It's a great question, Gray. Every property we look at, and if there's one takeaway you get from this podcast today, this interview, is this: every property you look at purchasing, make sure you have at least 2 or 3 exit strategies. And what I mean by that, are you going to fix and flip it? Are you going to buy and hold it? If you're going to buy and hold it, is it going to be a long-term or a short-term rental, meaning Airbnb or VRBO? Can you wholesale the property? Or can you just close on it, clean it up, and then hotel the property, turn around and resell it? So you need to look at a property and look at the numbers and analyze in such a way that if your primary exit strategy does not work, you need that fallback. And often what I see now in today's market, I see a lot of fix and flippers going after the $350,000 to $500,000 price point, and they're getting a hard money loan, and their hard money loan their rent will not cover the note if they have to convert that into a long-term rental. So, if they've got a note and they're paying $2,500 a month, but that property will only rent for $1,800 during the whole, $800 every month to maintain that note. So you've got to make sure you really understand your numbers and make sure if you're going to buy a property, and the market does turn, you have to be able to convert it into a buy and hold, refinance, and get most of your money out and keep it and cash flow it. Have a decent cap rate, have a decent cash flow, whether you're keeping it as a long-term or a short-term rental.
Yeah, that's good. I think that's the key, because I think that can stop a lot of people, because I think it's really wise to have multiple exit strategies. And hearing you kind of talk about that, I think a lot of investors can probably resonate with that, because it seems really sexy to buy the $500,000 property and put 100 into it and make a couple $100,000. But if you had 5 or 10 of those, and could you sustain that negative $800 cash flow per month? So I guess you probably go a little bit slower, but if we're building for the long term, which I think most investors should be, that's the way to kind of stick around. That's why I wanted to hear that question, because a lot of times you hear people talk about how good things are now. And so I think you got really interesting insight of, hey, you dug a hole and you dug yourself out of it, and kind of what you learned from that. So I think a lot of investors will be able to take some nuggets out from that strategy.
I think that a lot of times, especially out-of-state investors, it doesn't happen too often to the local investors. I'll get a call and the project went sideways and they're looking for me to bail them out. And I mean that in a nice way, with all due respect. And we end up buying the property and they take a significant loss. So for some of the investors locally, these out-of-state investors are calling them. They just say, hey, call me. And yeah, we'll buy the property. But there's been plenty of times when we've done so, and people have taken a fairly significant hit because they've subscribed to all these YouTube videos, these reality TV shows, and they think, oh, that looks easy, I can do that. And that's not the reality of what we go through every day on the ground. Now, I started the conversation by saying, I'm happily unemployed and it's a lifestyle. It is. It gives me the ability to travel and do the things I need. But also I have a team and I have a great partner to make sure that every day we're in the trenches to make sure we do the things we need to do to make the business successful. And a lot of investors, especially out of state, they don't treat it as a business. They hand it off to property management. They're really not involved other than getting their check. And you really need to be hands-on and continuing to learn every day new developments, new techniques, understand how property management works, understand your tenants, and then grow your education from there and continually learn. But what I found is the projects or the investors that go sideways are the ones that, have a very high level overview of investing. They have money, they buy a property, they hand off the property management, they hands off, and that's when the trouble starts. So I would caution people that, when you're starting out, is to be very hands-on.
Yeah, I think it's great experience. I mean, being hands-on and understanding, learning from the property manager, because if you want to scale this, totally agree. You need to kind of be hands-on on that. So are you telling me this is not like HGTV, what you're doing? Or you just
No, it's interesting. And I think you and the audience will laugh. A lot of times when I'm at social gatherings or settings, I'm in a big group and I'm meeting new people and they ask me what I do. I say I'm an AS400 database programmer. And because the moment I say I'm a real estate investor, then either they're like, oh, I've watched HGTV and I always wanted to do that, thinking it's really easy to do, or it's someone who's actually tried and they pepper me with 50 questions and I can't get away from them the whole night. I don't mind answering questions, but typically they want to ask a lot of questions. And before you know it, we go down that rabbit hole. So I try to make sure that I maintain a healthy perspective on how I approach this business. And I don't really, go around town and tell everyone, hey, I'm a real estate investor and feature me on HGTV, because, that's something that I think, that I can do, and everyone can do this. And that's just not the reality of it.
Yeah, it's a hard business, and even now, like you were talking about 2007, 2008, we've been in a really strong bull market. I know that, Jonathan, you watch the news, you're constantly kind of keeping up with the market. So tell me what your thoughts are, like where we are now. Here it is, May 2022. We've had an incredible run. Inventory's been low. Demand's been super high. What are your thoughts?
Interest rates are up.
Yeah, interest rates are up.
Well, I think it's a number of factors. I think what's happening in Europe now, there's a lot of supply chain issues, especially with China. People don't really look at the news, but what's happening in Ukraine, what's happening in China with COVID, where they've shut down cities that provide a lot of the materials here in the US. Cost of materials have gone up, 30, 40, 50, 100% in some areas. And that's going to adversely affect the profit margin if you're doing a fix and flip project. Rates in December went from, we do money broker, and we can certainly talk about that. It went from the low threes to right now it's 5.21 for a primary mortgage. So, if you're in the $250,000, $500,000 range and you're trying to flip a house, a lot of those buyers are rate sensitive. That means that, they don't want to buy something with 5.25% interest rate. And so therefore, are they going to just take the plunge and then refi in a couple of years as rates drop? Or are they going to just sit on the fence and say, hey, I'm stepping away and I just cannot afford this? Or because the interest rate has gone higher, they don't meet the lender's debt to income ratio, and therefore they don't qualify anymore for that particular property. And now they're already, they cannot enter the market as a home buyer. And what right now is propping up the market is inventory is at a historic low. The last time we've had this level of supply was 1999. And I think that right now is the only thing that is propping up the market. But this morning on Fortune, I was reading in Fortune magazine that they're already seeing that there's a drop in mortgage applications. There's a drop in contracts being written on properties. Properties are starting to sit on the market a little bit longer than previous. And so I think with the Fed raising rates and trying to get a handle on inflation, we will probably know come September if we're going to be entering a recession, and how that's going to impact the market. Now, again, low inventory is propping up the market, but I think if more people decide not to buy and sit on the fence, then you're going to see more availability of properties hit the market. They're going to sit there. It's going to flood the market. prices will eventually come down. And I think around September, we'll kind of know where the market will be. We'll know if the Fed is on track to avoid a recession, or if we even enter a recession, which I'd say the pundits, it's about 50-50 split, whether that's going to happen or not.
And what about for like out-of-state investor might not have any money in kind of equities right now, and they're looking to buy? Do you think that creates buying opportunities, or maybe just having more inventory? Like, yes, rates are up, and right now with prices kind of remaining, the same, interest rates are up, it basically eats into your returns. Does that still create buying opportunities? How should like a first time, or maybe they're buying their first, second, or third home, how should they be thinking about this market?
If you are looking to acquire turnkey rentals, and obviously through REI Trader or other turnkey providers, when the market starts to shift downward into a bear market, whether we enter a recession or not, passive investing, we are king. We benefit because lower price points means higher returns, higher cap rates, and more money in our pockets. So on a property we typically would pay $60,000 for and put $20,000 into it with $1,100 a month tenant at a 9 cap. Now we can get that property for maybe $45,000, and now a cap rate, maybe jumps up to about 12 or 12.5%. So in a bear market, passive investors will do very well. I think right now for a lot of investors who are looking to either buy a turnkey property and put their 20% down and hold it for long term, the next 10 years, it's a great time to do that. But you're going to be paying appraised value or full value of that property if you do so. But you're going to get the benefit of appreciation on the price. You'll get your tax benefits, and you'll be building equity as well. So it is a good time to get into that. The alternative is there's a lot of investors who don't want to buy turnkey properties. They want to buy it at a discount that's vacant, needs renovations. They want to hire a crew, go into it, do the renovations, do the heavy lifting, make it rent ready, tenant occupied, hand off the property management, and hopefully they've got a lot more equity in the property and then keep it for the long term. So that's really the two approaches. So you've got one where you don't have a lot of money, you can put 20% down plus closing costs to get your first turnkey property. Or if you've got a little bit more money, go find a property that you could buy from a wholesaler that needs renovations, do the heavy lifting, turnkey it yourself, and then keep it as a cash flowing asset as well. The challenge for that is by the time you get done doing so, more than likely you might have saved a few thousand and maybe $5,000 off of buying a turnkey from us or another turnkey provider, but you've learned a lot, and that's okay too.
Yeah. What is your time worth too? Because it can seem great on paper, but you start a refinance, even if you're going to pull out some of your capital, that has fees associated with it. And right now construction costs are up, and it's tough to find good work as well. It can just take a longer time to get stuff renovated. And so I think those are kind of two good insights and kind of two different ways to approach that right now.
Yeah. I would tell you this, if Birmingham is probably one of the strongest markets in the country for turnkey properties. I know a lot of investors from out of state who are successful at this, but they come here every month for a week. Sometimes they come here twice a month, and they're hands-on, they're at their properties, they're meeting with their teams, they're checking everything. They have significant oversight or boots on the ground to make sure things are moving forward. And those are the guys who are successful from out of state coming in and buying these properties and turnkeying it themselves. If that's not something you want to do, then I would just encourage you to buy a turnkey property from Evernest or from REI Trader, another turnkey provider. You don't want to go down that rabbit hole of trying to do the rehab yourself if you've never done it. If you're a new investor, a lot of contractors will figure that out. More than likely, you're going to pay a lot more than you probably should on renovating that property. And that's when the project goes sideways. And that's when I get a call to say, from someone saying, hey, I just need to get rid of this property. I offer them pennies on the dollar, and they're taking a $20,000, $30,000, $40,000 hit.
I heard a story about somebody they bought in Center Point, and, with all the regulations and permits that you need, they had paid a contractor. I mean, it was somewhere in the $40,000 to $70,000 range. and contractors stopped doing work and they had stop work order. They couldn't get a, CO and rent out the property. So it's, mistakes can definitely be made. So I think that's why we're here, basically trying to kind of impart all of our wisdom and kind of knowledge that investors can bypass and kind of sidestep those mistakes, because they can be costly.
Great. I don't remember. Yeah, I don't remember you calling me about that property. You're saying, "Hey, I've got a property for you." What happened?
I should have. I think she was trying to tough it out.
All right, Spencer, we have to talk.
Yeah, I know.
We'll hang on after this, but
that's right.
Kind of shifting gears, we'd love to talk about Birmingham specifically. You got a lot of experience, and kind of talk about the change that you've seen maybe over the past 10 years from you started investing to what the market looks like now.
Well, I mean, that's really a broad topic. When I first got here in September 2011, being a city kid, I moved downtown Birmingham on the north side. And of course, you guys know the area. And
Yep.
There was nothing going on. After 5 o'clock, it was like walking the streets. It's the Walking Dead. I mean, you might see 3 or 4 people, and we're talking the biggest city in the state of Alabama, with a metro area, population of like CMA of like 1.1 million, and the city probably has about 252,000 residents. There's no one out on the streets. Of course, today is completely different. The landscape is completely transformed. Downtown is booming. There's luxury condos, there's luxury rentals. They just built the protective stadium, the new football stadium with the USFL. We've got the World Games coming in July. We have the new baseball stadium, Railroad Park. I mean, it presents, we've got the Lyric Plaza, the Alabama Theater. I mean, it's booming. And, people are now taking a second look at Birmingham, and you're seeing a lot of transplants from out of state. They're saying, hey, this is a hip town. I want to be a part of it. And you're seeing a lot more transplants, not just from moving from within the state, locals or residents moving to Birmingham, but you're seeing a lot more people from out of state moving here, plus the tech corridor. You've got Shipt, you've got On Landing, which is another short-term rental platform that was based in San Francisco. They moved their whole team from San Francisco here to Birmingham. You got the Amazon that opened up a fulfillment center in Bessemer, which is just about 20 miles south of us, and also in Irondale, which is 8 miles west of us. Mm-hmm. So Birmingham is a completely different landscape than it was in 2011. I think it started, with Montgomery, our capital there, who offer these historic tax credits for developers to start, developing the downtown footprint and restoring these old buildings. And that, I think, was the catalyst that kind of started the process. And then Railroad Park came along and the baseball stadium came along. And as a result, those were anchors that now all of a sudden exploded. And now everything is new and shiny downtown. We have new overpass highways and roads. And, the mayor here is doing a great job. And, Birmingham has really come a long way in 10 years. I'm amazed. But when I moved here in 2011, I knew that Birmingham was the right market to be in. And when people asked me why I moved here, and I said real estate, they were shocked. They just didn't understand why I would move here and give up my beach house in Fort Lauderdale to move to Birmingham, Alabama. But I saw the opportunity because Birmingham is one of the few markets where you can fix and flip, you can wholesale, you can buy and hold, you can do long-term rentals, you can do short-term rentals. We do developments as well. You can do everything here. You can't do a lot of these strategies in other high-priced markets like in Miami or LA, or even in New York. It's very, very difficult. And if you do, we're talking millions of dollars of capital, and it's very high risk. So people who are in the Birmingham market, it's no wonder that a lot of our investors are from New York and California, because most of the houses that we do sell is in the sub $200,000. And for them, that's like, remodeling their kitchen.
Right. So let's talk about that, because you brought up a good point. I think just as you talked about, hey, Birmingham affords you the ability to do a lot of different things. Talk about how you have diversified your portfolio over the years, because I know that you've held on to a lot of long-term rentals, right? And the vast majority of those were single family residential, but even now you've started to diversify into multifamily, short-term rental. So what did that look like for you? What was the decision kind of going into that?
Yeah. The second takeaway, and this is very important for your audience to understand that they'll get out of today's podcast, is when you get into this and you start diversifying, is to have multiple streams of income. That was my primary goal when I came to Birmingham. When I came here, all I was doing was a few fix and flips and a few wholesale properties each month. That was it. I started diversifying. I got my real estate license as an agent. And then eventually I got my brokerage license. So now I broker deals for investors. So if you look at my streams of income, we fix and flip. I mean, we probably do 2 or 3 a month. Not a lot, they're in the sub 250 mark, but we do well on a fix and flips. We don't really wholesale as much as we used to. We do a few here and there, or we'll JV with other investors. We have a fairly large investor base or investor list. So, we'll JV some wholesale deals with other wholesalers that they need to move inventory and they can't do themselves. So that's primarily been the wholesaling route for us as of late. The brokerage, we will list properties for investors on the MLS and I'll make a commission there. We have north of probably about 100 rentals. Mostly single family doors. We'll talk about the multifamily. And so that's been significant cash flow for us as well. So that's, another way for us to generate cash flow is those rentals. And in the last year, we've gotten into money brokering. So, we help people secure loans, whether it's hard money loans or refinance on their single family or their rentals or their multifamily properties or portfolios. So that's been another revenue stream for us. And we just hired an assistant to kind of handle the underwriting for that. We are later this summer going to offer funding directly from REI Trader. We will fund projects on the local level. We will underwrite them directly. So that's another revenue stream that's going to be coming online. Then we have, last year, we got into the multifamily. We bought a 24-unit multifamily property over in the Center Point area where our office is located. And we do a lot of, that's a fairly significant footprint in that area. It's a 16-plex and 2 4-plexes. We're just about done with the 4-plexes. And hopefully by the end of this month, we'll be starting on a 16-plex. And we're kind of deciding we are going to keep it. It appraised for probably as is condition for about $850. When it's completed, we should be into it for about 1.1. It should appraise for about 2.3. So that's going to give us significant cash flow, another 24 doors. We could also build another 4-plex on the property and also another 16-plex building we could put on the property. So we'll increase that footprint from 24 to 40 doors. We're also doing developments. The reason we haven't done it yet, and people keep asking us in the last 3 years, 4 years, we own the land and we're trying to acquire some additional land, one for a 34 garden home development, another for a 55 townhome development, is just the cost of labor. It's been so high. So as things start to come down, we're hoping to break ground, fingers crossed, by the end of this year. And lastly, since the beginning of this year, we've entered the short-term rental market, and this is Airbnbs and VRBO and Booking.com properties. We've converted 3 properties initially to test it over from long-term rentals to short-term rentals. And they have been doing really well. We're bringing our 3rd one online next week, but the 2 that we've already put up and has been operating for about 6 weeks have far exceeded our expectations. And we realize that Birmingham now has turned into a great opportunity for short-term rentals for Airbnb or VRBO. And I'm very, very bullish on that opportunity for our company.
I was just talking to a business owner today. I was interviewing him about Birmingham, why he has his business here in Birmingham, and it's not a global company; it's a nationwide company. And so he's hiring people from all over the country. And he says one of the things that they always say to me is, "You don't have enough Airbnb choices here in Birmingham." So he puts them up in a nice hotel or whatever. But just to your point, Jonathan, that's definitely something that's needed here.
I saw that we got ranked like it was some food blogger, and they put us like number 3 places to travel like worldwide. So you're up there with like cities in Italy, and they've got Birmingham up there in the top 10. And I was like, that is shocking. I mean, but it's got a good food scene, and it's interesting to see Birmingham get out west compared to where it's been 10 years ago.
It's a good thing you mentioned that, Gray, because Condé Nast Travel, I think, is one you're referencing, one of the premier travel magazines in the country. And I travel a lot, as you guys know. I think it was the end of last year, they posted the top 100 places in the world to visit. Birmingham was number 1, and specifically for the food scene. But Birmingham, I was floored, put on my Facebook profile, and just floored that Birmingham was ranked number 1 above Paris and New York and Budapest, which was surprising. So I think Birmingham has a lot to offer. Of course, I think, being in the Deep South and where the civil rights movement started, I think people have a negative perception of, my adopted state. And so I always find I'm educating people, how do you live down there and what are the people like? And I just tell them it's a well-kept secret, and it's really the friendliest people I've ever met in my entire life. And I've traveled a lot. So, and that's fine. So word gets out and more people come here to explore our great city and our great state. I think it's a windfall for us and for the people here in the state of Alabama.
Yeah, investors come here and they really are kind of blown away when they see the hills. They're like, "Oh wow, I didn't think it was so mountainous," even though they're just kind of hills
and green.
And green, super green. But we have 60 James Beard Award nominations. Mm-hmm. Of course, you've got like Chris Hastings here. You have Frank Stitt here. I mean, we're talking some of the best chefs in the world.
So if you're going to come on a monthly basis, you got good food options. If you take Jonathan's strategy of being hands-on and coming down here, or even just come check out properties and drive some of these neighborhoods, we'll take you out some good restaurants.
That's right.
What is the multifamily? Because a lot of people ask that and would love your take on it. There's a lot of single family. Is there a lot of multifamily going on? Because I think a lot of people here, hey, economies of scale and want to trade up to these income based properties. What's been your experience with most of your portfolio being single family? What's the inventory like for Birmingham and multifamily properties?
Incredibly tight, incredibly competitive. It's very, very hard for someone who's not from this area to pick up a property like that. I find that the ones that we have access to right now, we're chasing 187 unit property that's distressed on the north side of town. And we got that from a couple of attorneys who call us and say, hey, we have this opportunity and we think you might have an interest in it. So we'll probably know by the end of the summer if we're going to have the opportunity to buy that. I mean, but we're talking 187 unit, very distressed, needs a tremendous amount of work. I mean, you were talking $5 to $7 million of just renovations alone on that particular property.
Wow.
And we're bullish on getting it, but the only way we get access to those opportunities is on the relationships and the network, local people that know, like you guys, and vice versa. So, for a lot of people who are coming out of state who want to buy multifamily, it's really hard to do that. And if you're going to buy them, you're going to be paying a premium. You're going to be paying basically full market value for it. Your cap rate right now on opportunities I see from other wholesalers or brokers or anything on LoopNet, I mean, they're like at a 4 cap, which doesn't leave a lot of room for maintenance issues or things that can go wrong on the property. I mean, that's a very, very thin margin. I mean, for us, our portfolio across all of our properties, we're at about a 9.1, 9.2 cap rate. And that's pretty healthy in a market like this. But anything less than, let's say, 7, it's not something for me personally, I would even consider buying. So when someone offers me a multifamily, I'll line up the numbers and I cannot get to at least a 7 cap. It's not something unfortunately, it doesn't fit our buy box.
Yeah. And it's tough right now with rates going up. I mean, you're still seeing some of the agency debt. It's kind of in the mid 4s, maybe the low 5s, but it makes it tougher to do that unless there's a big value add component and you can significantly raise your rates to kind of get that stabilized number above that. So that's interesting.
I do find that there are a lot of great investors here who were successful, but they're participating in a syndicate. You join a group, you're all pulling your money, and you've got 28 people who are partners in a syndicate, and you're going out and you're buying this 200 multifamily development in Huntsville, and that's great. And so you're getting some cash flow, and you're putting your money to work. But I haven't really subscribed to syndicating in those funds. I haven't done enough research for me to actually jump into that. I prefer, for me personally, for doing this for so long, I want to control the asset. I don't want to, and I want to be the majority owner. I don't want, for me to have 3% stake in a company and like in a Fundrise project, and I don't have control. So I guess I'm just built that way. Other people on a project like that, you could actually invest and you can be completely hands off, and you can eventually get your monthly residual income, your passive income. That's great. That just hasn't been a fit for me personally, as well as for the company.
Yeah, well, I don't think you've had to do that, right? For the past 20 years, that's not been something that you've needed to do, and so it doesn't really make sense for you.
I think it can make sense. I think that's probably one of the most passive ways, if you really kind of trust the GP or the general partner in that deal. It can be passive, and I think it makes sense for different people. But I think you being local and being very entrepreneurial yourself, the route you've made has made a lot of sense. And I was going to hit on something you talked about earlier. I was asking how you get access to these multifamily deals. You've got a really good reputation, or a reputation to close, and a reputation with how you act. And you also just in the game. And so it's hard, and I've seen this from investors, it's hard to come across this unless you're in the game. So don't go looking for the home run deal. Even if you start buying single families, you'll start talking to contractors and lenders and other investors, and you start to build this reputation of credibility, and other deals will start coming your way. But it's taken you 10 years in the Birmingham market to start getting into some of these bigger multifamily projects. And so I think those are all kind of like recipes of like why you've been successful, and what other investors can take is reputation and just your network. And the way you get a network is kind of getting involved and talking to a lot of people. And it's easier to talk shop if you've got a couple properties, and there's kind of natural synergies there. Yeah.
And I think, everything is built on relationships. And this past Monday, I sat down. Typically I get investors who call me all the time, whether they're coming from out of town or local, and say, listen, I'd just like to buy you a coffee and sit down. And so this past Monday morning, I sat down with a local investor. He just want to pick my brains. We had coffee. I spent an hour with him. He kind of lined up his vision of what he's looking to do. I kind of guided him, gave him a couple of, examples of, where he should be focusing on. And it was really fruitful for him. And, he's got a full-time job. He's trying to make that transition to doing it, moving away from the full-time gig, 9-to-5 job, and moving into doing this full-time. So, we talked a little bit about that. And so the reason I bring that up is, people might say, well, you do this for so long, and this is fairly someone new. Why would you even spend an hour with this person? And I think, eventually, this person may bring a deal to me, bring an opportunity, or he may know someone, and they're going to say, hey, and that's happened quite a bit. Yeah. Where someone has called me and said, hey, I have this opportunity, and they're pointing it to me. So building those relationships, even with newer investors, I think is really critical to your success. Of course, when I get bombarded with, requests for my coffee time, then it becomes a little bit more of a challenge to kind of set aside some time to sit down and talk to investors and kind of guide them. But I look at it as a way to build relationships, because eventually it's going to, at some point, lead to an opportunity. We had one property where sat down with an appraiser. He wanted to get in investing. He sat down with him for an hour, coffee talk. A few weeks later, this individual called me. It's an estate sale. His uncle passed away, and he, was responsible for, selling the estate. And it was a great house. And I bought it for $35,000. It's worth about $150,000. I put about $20,000 into it. And it's one of our short-term rentals, and it's an absolute cash cow. But the only way I found that opportunity is because I sat down with that appraiser. I took the time. He wasn't ready to actually buy properties. Oh. And so with this friend of his called him and said, listen, I'm trying to sell my family, one of my family properties. Who should I call? This person said, call Jonathan. And it led to us buying this property. And then, we have it in inventory. It's a property I'll never sell. So it's super important to build those relationships right from the start. Go to the local RIA meetings. There's a lot of great meetups here, and network with everyone and start building those relationships.
Yeah, great advice, Jonathan. So I'm just going to ask this last question as we wrap this up. So great advice for the local investor. We have a lot of out-of-state investors who listen to this. What is one piece of advice you would give them as they're building their own portfolio, like from California in these different markets? What's one piece of advice you can give them as they look to grow that maybe to where you are? Maybe they want to grow to 100 rental properties and they're at 1 or 2 or 3 right now.
Yeah, that's a great question. I think that they should focus to start on one market, really understand that market, learn it, research it, visit it, make sure you meet all the key players on your team, look in their eye and get a sense of, are they going to watch? Are they going to have my back on the properties that I buy here? Master that market, master that technique, whether you're buying turnkey, whether you're fixing and flipping and wholesaling, or buying, converting them to turnkeys and for long-term holds, or if you're doing short-term versus long-term rentals. Second, focus on just one strategy. If you're new at this, trying to do multiple exits and multiple streams of income right from the start to put everything on the table, it's too much. You're going to lose sight. You're going to lose your focus. And you really need to kind of focus on one strategy, one market. You master it, and then you move on to the next one. And then as you do that, you can now pick up another market and just wash, rinse, and repeat. So develop your process, develop your model in one specific market, be really good at it. And then when you feel like you need to move into another market, it's a whole lot easier because you're just duplicating what you've learned in the primary market into your secondary markets.
Awesome. Great advice, Jonathan. As always, man, we appreciate your time. We know you're super busy and you're heading out of town next week. So we appreciate the time you spent with us today.
Hey, my pleasure, guys. It's always great to hang out with you guys, and always enjoy my time here with the Evernest team.
All right. Well, we'll have you back on this show again at some point. And everyone, if you haven't already, go ahead and leave us a review. If you've enjoyed this episode, we'd love to hear from you. And we'll be back in 1 week with another episode of the Evernest Real Estate Investor Podcast.